If you've ever sat down at a blackjack table and won a few hands, you know the rush of winning some quick cash. You probably also know how it feels to lose. Investing in the stock market is like gambling, but instead of betting that your hand is better than the dealer's, you're betting that a company, or group of them, will perform a certain way over time. There are no guarantees. Companies can go bankrupt, stocks can lose their value and never recover, and investments might be down when you need the cash. Negative outcomes are especially possible during downturns, like the one the market is experiencing now. But overall, the stock market has much better odds than a trip to Vegas, if you're willing to follow two key rules of the game: diversify and wait. The chances of winning real money in a casino are very low, depending on the game. That's because for all casino games, the house has an edge, meaning the casino is favored to win. And this is true for all casino games, whether they involve skill or not, according to the American Gaming Association. Single-deck blackjack has some of the best odds, with the chance of beating the house decreasing for games that use multiple decks. But unlike in blackjack, you can't take your winnings home at the end of the day when you invest, unless you're a day trader. For most of us, investing in stocks is a longer-term proposition. Why? Statistics show it pays to be patient. Over the last 97 years, the S&P 500 has gone up and down many times, but it had a positive annual return 66% of the time. When you zoom out to 5-year increments, the percentage ending on a positive note rises to more than 76%. And when you look at 10-year periods, over 86% had a positive return. Meanwhile, with casino games, you're statistically bound to lose. Blackjack's house advantage ranges from 0.5% to 3%, according to the American Gaming Association, compared to as much as 12% for penny and nickel slots. While your odds per hand change depending on the cards you're dealt and what the dealer holds, for every $100 you wager over a reasonable period, a person of average skill is bound to lose 50 cents to $3 playing blackjack, and as much as $12 on penny or nickel slots. The average annual return for the modern S&P 500, which started in 1957, is more than 8.5% or 5% adjusted for inflation. If you were lucky enough to invest in one of the so-called Magnificent Seven stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, you'd be up a lot more. And talk to anyone who chose a big winner in the 2000s or 2010s, and you know they might be sitting on small fortunes. But experts recommend diversifying your stock portfolio because you can just as easily make a losing bet. And the success of the recent past does not guarantee the next year or 10-year period will perform as well. The lower odds of casino play don't mean people are staying away. On the contrary, US commercial gaming revenue reached an annual record in 2024. People spent nearly $72 billion in casinos, gambling online, and on sports betting last year, up 7.5% over the previous year, and the industry's fourth straight year with record revenue. And the vast majority of that money, nearly $50 billion, was spent inside brick-and-mortar casinos. So while stock market investing may not give you the same rush as sitting down at the betting table, you should consider it if you want a more time-tested path to growing your money. And investing can be fun too. If you have the ability to think of some of your investments as play money, you could, for example, put 95% of your portfolio in diversified ETFs and 5% into a speculative stock or crypto. Of course, talk to a financial advisor to figure out what strategy is best for you. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. And we'll see you next time.